son. Anyway, there's three bad investments to be in during high inflation, and three good places to have your money during high inflation. The three bad places are cash, checking, or savings in the bank, because you don't earn enough to stay ahead of inflation. You lose buying power. The second is CDs, very similar. You might make a little more interest than you do in cash than you do on savings or checking accounts, but the interest rate on CDs never is ahead of inflation, and you lose buying power. And the third is bonds. And bonds, although they seem safe, bond market values over on this hand and interest rates over on this hand, it's an inverse relationship. So if interest rates go up, bond market values go down. And I believe that interest rates are inevitable to continue to go up because of the inevitable inflation, because of all the money that the government has printed. They're going to keep going up. And so those are the three bad places to have money, or places where you lose buying power in high inflation environments. The three good are, first off, if you think about what inflation is, it's the rising cost of goods and services. And when I say that to people in the office, every time I say that, they go, yeah, that's what inflation is. Well, a logical great hedge against the rising cost of goods and services are to own the companies that produce and sell the goods and services for a profit. And so that's logical. I can also prove it to you with some in the office, if you want to see it, with the historical performance of the stock market when we had super duper high inflation before, which was the late 70s and early 80s. Depending on what time frame you're looking at or what years you look at, the S&P 500 made anywhere between 15.5% and 16.5% per year, outpacing inflation by 8.5% per year. It's the best hedge against inflation because it's kind of fitted in with inflation because they produce and sell the goods and services whose prices are going up. So that's the first one. The second one is income producing real estate. With income producing real estate, and when we have inflation, both the real estate value and over time your rent will go up. And then the third is gold. And gold is a hedge against inflation, but I don't like it as much as real estate because it doesn't produce any income or any rent. And I don't like it as much as companies because it doesn't produce a good or a service whose prices are going up.
So to close, it's our job as financial advisors to help our clients and help you position your portfolio in a way that can withstand ups and downs of the market over your investing life. And it's also our job to make sure that you don't make mistakes that can cost you a lot of money, such as panic selling or getting out at the bottom of the market by trying to time it. So when we give advice or say that now is the time to stay the course or now is the time to buy, that's because that's actually the best strategy, not just what we believe, but that's backed up by
our experience and
historical
historical facts.